Yo, what's going on, y'all? In this section, I will be talking about probabilities in trading, as well as being able to keep your head up while you're in a losing streak and things like that, as well as having to understand that trading is all about probabilities. So in this game, we want to create a probability-based mindset, and that is exactly what I'll be showing you guys today and how you guys can create this type of mindset rather quickly. Because I remember when I started trading in the beginning, first year or so, I was trading off no data. Okay, it was I wouldn't say it's pure gambling because I knew technical analysis. I had analysis. Obviously, it's not as good as what I taught you guys now as and what I have now, but I didn't have clear, concise data that I kept track of for all my trades and just a lot of things that would help me think in more probabilities, right? There's a reason why all these hedge funds, when you interview for them, they give you a lot of puzzle-based questions about probabilities rather than giving you tons of technical analysis questions. Because technical analysis you can teach anyone, right? Of course, it does take time to develop the experience of technical analysis, but being able to not go on tilt while trading, keeping your emotions stable, and having this probabilistic mindset is very important as well. I personally, you guys know, I don't vouch for psychology that much, mainly because I believe that trading should be 80% technical, 20% psychological. Of course, you can mix in risk management in there as well, but it's because if you don't have an edge, you're not going to be profitable. But also, if you don't have good psychology, you can't control or stick to your plan's not going to, your edge is just not going to play out, right? So in today's video, I'm just going to be going over real quick probabilities, right? How to think in probabilities and what type of probabilities you should expect. So let's say there's two types of traders. We have trader A, and then we also have trader B. Typically, you guys know risk to reward and win rate are typically inversely correlated. So when you have a higher win rate, you would typically have a lower average risk to reward. Same thing with the other way around, right? If you have a higher risk to reward, you will most likely have a lower win rate. Now, yes, you can get a solid balance between the two. That is everyone's goal. You can even have a high win rate and high risk to reward, which I do teach. If you guys check out the course and this other content inside the course, there are ways you can do that. However, there are certain things that a lot of people just don't know about it and how you can actually execute and manage your risk properly in those situations where you can, using break even and many other things to alleviate that some losses, right, in your system, even trading high risk reward. But today, let's say trader A is the high win rate, low RR, and then risk reward stands for R, low win rate, high R. So these two types of traders we have to understand have two different equity curves. So let me just real quick. There are two types of equity curves for these two traders. I'm just going to do this real quick. And if you guys didn't know, I did release the advanced course out now as well. You guys can just check it out on the ETU website. It's already out there. It says advanced. It's for people that are looking further to learn my exact trading system that I use every day to make really good returns every single month. Okay, so trader A, high win rate, low risk reward. The equity curve of this trader is going to look something like this. Again, depends exactly on the stats. However, I'll show an example. Trade 1 win. Let's say trade 2 they win again. And trade 3 they win again. They lose one trade. Okay, and then they win again. They win again. Lose one trade. Maybe lose one trade. Win, win, win. The equity curve looks like something like this, right? Higher lows, higher highs, just like market structure. Not the best drawing, but you guys get the point. Trader B, they have a low win rate and high risk reward. So what happens is essentially their win rate, because it is low, maybe let's say they start with one win, and then they lose, they lose, they lose, they lose, another big win. They lose, they lose, they lose, they lose. Maybe they keep losing a few and then another win. So you can see this trader, their win rate in high risk reward combination, they have a lot more volatile equity curve. Okay, it's not going to look like this exactly because this is not drawn to scale with the dips being the same size in correlation to X and Y axis, if you guys understand that. But it would look something like this, right? We want something that's more stable A perfect equity curve would be like this. Okay, going to 9 degrees. Now, no one has an equity curve like that unless you take one trade and you win 100%, and that's it. You stop trading forever. We're not gamblers out here, so we don't have an equity curve like that. The perfect equity curve would be something like this at a 45-degree angle. This is perfect. Okay, this means your trading is very, very stable. Minimal drawdown and maximum output is what we're looking for. Okay, so for trader B with a low win rate, high R, they're just going to have bigger drawdown periods and bigger wins as well, which then causes a huge spike in their equity curve because they have bigger wins. Okay, so now that we understand the two different types of equity curves, this shows that for someone, if you have a low win rate, high risk reward system, this all depends on your trading system, your data. I already showed my members my data that I have for my trading systems. But if you guys want to create something else for yourself, then feel free to do so. Again, I personally don't believe in reinventing the wheel, but you guys can do that if you want to. But yeah, so if you know you're based on your data collection, whether that's forward test, back test, any type of solid objectified data you have for your trading setup, and let's say you're trader B, then you know that your equity curve is gonna expect something like this, and you're gonna expect a lot of losses in a row before you get that one big win, right? It covers all your losses plus some. Versus trader A, where you can expect a lot of wins in a row, but you also know that your losers are the same size as your winners, for example. So you have to just understand that. So different types of equity curves and systems have different types of drawdown amounts, which is exactly what I'm going to show right here. So right here is a chart I got from, I think, FTMO, I believe. I don't remember exactly where, but this chart is very, very helpful in my opinion. I think it's great to show everyone how trading should look like and the stats behind your trading system, right? And what you can expect. There's different types of charts for these. I believe I'm checking another one right now, and they have different percentages for, I'll show you guys in a bit right here. They have different percentages of the wins and losses. So we'll go over that real quick, show you guys the other one, but let's go over this one first. So this one first is the probability of seeing at least an X consecutive losing trades within a 50 trade period. So 50 trades, this all depends on how many trades you take, right? Let's say you take 50 trades in a year. That's very low for someone like me that trades intraday. I typically take 5 trades a day, so 100 trades a month. So I can just double this. But essentially, let's say you take 50 trades a month. I think that's pretty solid, right? Maybe that's about 2 trades a day. Things to around 20 trading days, active trading days in a month. So let's say you take 50 trades in a month. What you can expect, let's say your win rate is, regardless of your risk reward, this is nothing to do with risk reward. This is just based on win rate, right? Win rate tells you your drawdown, losing periods, things like that. Your RR just tells you your size, your wins and losses, of course. So let's say your win rate is 35%. Your probability of seeing 9 losing trades is 58% within 50 trades. That's a lot. I'm not gonna lie. 9 losing trades in a row is a lot to handle. Let's say you're someone that masters psychology. For me personally, I feel like psychology is not a problem for me at all because I've gone through so much trading experience, I've done this for so long that I've kind of you could say you reshape your brain of how it views money. Okay, so I view money very different than a normal person that I might be seeing outside working a normal job. I don't view money as time. A lot of people, when they work a 9 to 5, they view money as time, which I'm not saying is a problem at all. It's just how, not how you should view money if you're really trying to professionally trade for a living, right? You can't view money as time because, for example, time in the chart right now for me does not mean I make more money. Trading is more about making the right decisions at the right time and being patient than always continuously trying to take a trade, right? That is actually completely opposite what you should be doing. So in trading, you have a 35% win rate. You're expected to have non-losing trades. 58% chance you have non-losing trades in a row in the 50 trade period. 50 trade period is not a lot at all. Okay, so let's say since I take 100 trades a month, you know, my if I had a 35% win rate, which I don't, but if I had one right here, I can expect non-losing trades in a row. And my question to myself is, can I deal with that psychologically, emotionally? Yes or no? If I can't, then I need to find a better system or find ways to refine my edge so my win rate goes up to this quartile here, this upper half here. And if that requires, taking my risk reward averages down, then so be it. That's better for me and as a person, right? But yes, I believe you can master psychology at a lower win rate. If you've done it for a very long time, you just trust your edge, you keep executing, and you will be profitable. But of course, this is given with the requisite that you already have an edge as proven, right? Otherwise, then it's useless. So let's say you have now you guys can see, let's say you have a 70% win rate. You have a 73% chance of losing 3 trades in a row within a 50 trade period. And your odds of losing more than that is a lot lower. It's less than 50%. You guys can see you rarely ever encounter 6 losses in a row. Rarely ever. Seven's basically impossible. 1% chance, right? Within a 50 trade period, of course. Now, when this number, 50 trade period, increases, these numbers and percentages will change. Why? Because you're taking a large and bigger sample size, which means you will have bigger winning streaks as well as bigger losing streaks. These things grow in proportion. So that's something you got to keep understand. This is just within a 50 trade period. Okay, this is standard that you guys should follow. This just helps you guys understand about probabilities and why I should be trading and executing based on probabilities. So if you know you have a 35% win rate system, you should not be scared if you're losing 9 trades in a row within a 50 trade period because you know that is statistically a possibility that's going to occur. Now, for what I teach everyone, my students, is that if you have a yeah, everyone knows if you have the one-to-one risk reward, you just need more than 50% win rate to have an edge, right? However, because of real market conditions like spread, we have spread, or fill issues, commissions, things like that. There's also emotions attached to live trading, right? Now, I'm not saying anyone is perfect. No one's gonna probably be able to execute 100% of all their trades and not make a single gamble trade, I call it, which is a trade outside of your predefined setup in a whole year. I doubt it. Okay, there's probably no matter how good of a trader you are, you probably have made one at least, hopefully, or not hopefully, but you probably definitely have within a year. A year's a long time of trading. That's a ton of trades. Okay, so no one's perfect. So your edge that you back test is going to be a better version of what your real market data is going to be. So let's say you have a one-to-one risk reward at 60% back tested. In a live market, you might actually only have a one-to-one risk reward with 50% win rate or 55% win rate. It will rarely ever be above your back tested win rate unless you improved as a trader and you change some stuff in your system, right? Otherwise, then it doesn't make sense for your statistics or data to change. Of course, as a taking into account you have a roughly pretty big sample size and not just across 3 trades or 10 trades. Okay, so that's something to take into consideration. You guys know that these numbers right here. Now, personally, for me, what I always recommend is if you're going to have a one-to-one risk reward, like static, something, whatever you guys, your average one-to-one risk reward, you should at least have a bad tested win rate of 70% more. Hopefully live 70% win rate or more. This gives you enough cushioning where you can take on potentially making some emotional trades and still be break even or going in uptrend on your equity curve. Or gives you some um, space for spread and commissions, right? So let's say you're following your plan, you're doing good in your equity curve, and then you're up here, right? Your initial balance is here, right here. Let's say you make few emotional trades. It gives you back to almost break even. Let's say you take a ton of revenge trades, but if you're still following your plan, you still be at least break even or green still, right? So this gives you enough wiggle room to do that. That's why I recommend if you have a one-to-one win rate, you want a system that gives you at least a 70% win rate return, at least. Oh, 70% win rate minimum. Now my rule is for 1 to 2 RR. The other systems you don't have to follow these exactly, but it's mainly for the people training 1-to-1. Okay, 1 to 2, it does get a bit more complicated with the math. Of course, you only need, or I think around 33% winner to have an edge. You just do 1 divided by 3. I would recommend for 1 to at least have 50% win rate. Okay. 1 to 3, then these numbers change. This is when you need a 25% or more to have an edge. I'm just doing mental math here. 1 divided by 4. And you should probably try to get at least a 40% win rate. So this gives you enough cushioning. Make sure your backtesting and your edge, even live training, has enough cushioning so that you can afford to make some of these mistakes or spread in commissions, right? For those risk reward losses that you cannot change. So that is something you definitely want to take into consideration. So for me, if I was when let's say I was training a one-to-one system, I do have a one-to-one system that I do trade, and the win rate for my one-to-one system is around the 75 to 80% range. So usually it falls between these two win rates for my one-to-one system, and so therefore within 50 trade period, I can expect probability of losing 3 trades in a row. After that, it's very low probability, as you can see. I basically never lose more than 5 in a row. I think this month so far I've lost 2 in a row at max, 2 to 3 in a row at max. So that makes complete sense, and also I'm taking a lot of trades. So that's something you definitely want to take into consideration. Now I'm going to be showing you guys a different chart here. This is 100 trades in a row. I forgot what website got this off from, but you guys can see the numbers got to be different here, right? Let's see. Numbers are most definitely different. Look at 70% here, 70% here. Your chance of 3 trades losing trades in a row is 93% across 100 trades, while it's only 30% across 50 trades. So these don't scale linearly, but you guys can see from this data that you understand that the more trades you take, the more winners you're going to expect in terms of streaks as well as losers. It's proportional. So when we trade and think this way, this helps us stay calm when we trade or go through losing streaks and understanding our data. Again, finding a system that works best for your mentality, in my opinion, and works for you is great too. Again, I do believe you can change your brain to also fit a system that you are naturally not good at, but you can change your system or change your brain chemistry to fit that system, right? So for me personally, I could do both systems. It does not matter to me as long as it has an edge and I'm profitable. I can trade it, right? Like a robot, essentially. So one last thing I want to talk about is also based on those stats. If you look at like a calendar, a number of days, you also want to keep track of this. This is another stat you want to keep track of is how many days are you green from your back testing? Either through back testing or live training, which is even better. How many days are you green? You want to keep track of this number and keep track of your data. So for me personally, 80% of my days are green and I have 20% red days. Okay. And what you really want to do as a trader is regardless of your stats, obviously the better your stats, the better your expectancy and profit factor, the less red days you will have, and it should be smaller, right? So red days, keep red days less than or equal to green days. So the amount you lose on your red days should be less than or equal to your green days. Let's say you lose 2 days here, maybe 3 days, and all these other days here are green, right? You want to make sure these green days here outweigh our red days. So essentially, one green day is like a one-to-one risk reward that covers your red day. Okay, this way you can maintain longevity and have a very, very beautiful equity curve. Very, very beautiful equity curve. So something like this. My calendar looks something like this. This is something you want to keep track of, and you do want these numbers to be in your favor. This way you can have a stable income. A lot of people say trading is not a stable income. I agree, it's not a stable income because there are days you lose money. You cannot win 100% your days. I have not seen a trader that has not lost a single day in a span of a year. Unless they take like 2 trades a year, then maybe. This all depends on your trade frequency, right? So there's also also another factor. If you're just swing trading, you might only take 1 trade this whole week. So then you might have 1 red day here and then 1 green day and then 1 red day, but you're still overall up, right? So this all depends again on your trading system. But that's how I like to view probabilities, and you guys should be keeping this in the back of your mind while you're trading. One last thing I do want to cover, or in fact, I have 2 more things to cover. The next thing is again just about probabilities, right? So understand that the smaller your trade sample size, the less accurate it is. So let's say you have a 70% backtest win rate with 1-to-1. This is just to make everything very simple to see. But across, let's say, your first 10 trades, let's say your first 10 trades you take on your accounts, you only won 40% of them. But then people start going on tilt, revenge trading, taking random trades, gambling with no data, and then losing even more, right? So that never works out. Never emotional trade. Never do that. Stick to your plan and system if you have a bad tested proven edge. So that's your first 10 trades. You win 4 out of 10. So you have a 40% win rate. However, people don't seem to understand how numbers work and the law of big data, big numbers. If you can take a statistics class, it would help a lot also. But essentially, your overall win rate across a huge sample size, 70%, not your next 10 trades. So you can't expect next 10 trades, I'm gonna win 7 out of 10. If it doesn't work, the system sucks, or I'm doing something wrong. You might not be doing something wrong. Maybe try seeing if you're doing something wrong technically or emotionally, but most likely you probably aren't, right? And let's say from 11 to 20, you win. I don't know the math here right now, but let's say you win 8 trades from 11 to 20. So you win first 4 trades, and then you win 8 trades. That's 12 wins. And then what does that mean? That leaves us with 8 losses. Okay, let's do these numbers. Let's say you win 10 in a row, next 10. This is very unlikely. This is just for purposes of this right here. So that'll be a 14 out of 20 win rate across 20 trades. You finally hit the 70% win rate mark. Now, this is 70%. So now you finally hit the 70% win rate mark after taking a bigger sample size number of trades. Now imagine you take up to like 1,000, 10,000 trades. This is gonna get even closer and closer to your overall bad tested number. This is taking into the consideration that your bad test was a big sample size, not just 10 trades, right? Whoever have a bad test of 10 trades, I would recommend at least have 500. I've done 4,000 trades for my bad testing. Took me a very long time, I will say, to mainly do all that and collect the data on it and see what works and see what doesn't work. That's also why I don't undercharge for any of my mentorships or courses because of the amount of time I spent. And I know this will save you guys a ton of time on your journey when you're learning from someone that already has done the work, right? So that's how you should also view trading, right? In terms of a numbers game. It's always a numbers game. Now, I want to bring everyone's attention to this quick little site right here. It's actually called winrate.io. I highly recommend you guys to check this out. Okay, this is a super nice website that I have just bookmarked. It's very interesting to see. This helps you guys understand trading from a more probabilistic mindset. I would say bad testing helped me a ton with understanding how to trade just from pure data, but this site will help you understand everything too as well. So, for example, right here, you don't have to worry about these percentages here. I just leave them like this because this is kind of like fees. You can just leave at that default percent. It's not going to make a big difference in the long run at all whatsoever. So ignore that. Let's say you have a starting balance. Let's say you have a win rate 70%, 1-to-1 risk reward. Okay? You risk 1% per trade. You lose 1% if you lose. Number of trades. Okay, for me, you got to do the math here for your trading system. Okay, for me, my trading system, I take about 100 trades a month. So in a span of a year, it'll be over 1,000. It'll be around 1,200 ish. But I'm gonna put 1,000 to keep the numbers simple. Okay, and then exchange, you don't have to worry about that. And this right here is actually gonna be very important. I'll show you guys a bit later. This is basically to consider compounding or not. So let's say you guys see, I think it should work here. I run this strategy real quick. Okay, this is not compounding. 1% of 10,000 or 1,000, you guys know, is $10. So you guys can see if you keep scrolling down. Okay, this is still compounding a little bit. You're gonna have to test around with these numbers. This is $1. So then I think this should be good right here now. Okay, yeah, if you set this number, okay, some outliers here, but it's because of fees and commission. That's gonna be fine, honestly. So right here, this is without compounding. Over 1,000 trades, risking 1% with a 70% win rate, 1-to-1 risk reward ratio. In the span of 1 year, since 1,000 trades for me is in 1 year, I will have a gross return of 320%, which is nice, you know? That is what, 30% a month roughly 30% return a month. That's 30R a month. Okay, so imagine that on a bigger account. Let's change this number here to 10K now. You would go from 10K to, this is wrong. Why? Because when you change these numbers, you want to change this to max position size to match it. So now it's 10K. So now, yeah, so now you're risking 1% of 10K, which is $100. As you can see, now with bigger capital, you're making more money proportionally, right? It's nice. Now let's say you go to 100K. This could be on a fund account, whatever. Now you get a return that's up to your account. You grew your account basically from 100K to 400K. So you made 300K in a year. Trading 70% win rate, 1-to-1 risk reward, that's it. We don't need 90% win rate, 6R average. That's, first of all, that's impossible. Unless I don't know what type of human you are, but I don't think that's possible, okay? So stop looking for a holy grail, start focusing on consistency. Here is a perfect example of risking the same amount as NC every time is roughly $1,000 on 100K. And over span, your account just grows massively, okay? Over more numbers. So trade frequency is very important data point is what I'm trying to say, get out here today. Trade frequency is also very important because if you have a system that's very high win rate, this is how people have a high win rate, high risk reward system. They have an 80% win rate with a 6R average. That's possible, but their setup has so many filters that they don't take many trades a year. So let's say they only take 10 trades a year. We can do the math here. Let's do 80% of 5. That's a lot more accurate. You can see, despite them having way better stats than you, they're making way less returns. Only 37% return in a month or in a year. Now, yes, this is less effort, but this is way less return, and it's very hard to make a living off of return this low unless you have a ton of capital. So what I'm trying to tell you guys is stop focusing too much on stats. Stats are indeed important. Make sure you have an edge that's covering commissions, everything, and just keep executing. With a large sample size, you will make a lot. That's 300K. And imagine this in the following year, the following year after that. It gets even bigger, right? Now, that is with normal risk percent per trade, which I teach you guys. I teach everyone to risk the same amount percent per trade, even if you're in drawdown, because if you keep reducing your risk in drawdown, it's going to take you long to get out of that drawdown, and you're not letting your numbers and edge play out. Because let's say you lose the first 3 trades, you're down, let's say, $300, and then the 4th trade, you decide to reduce your risk to half risk. Now your 1 to 4, whatever, turns into a 1 to 2 risk reward. And it takes even longer to get back out drawdown. This is why I highly recommend stick to your training plan and make a risk management system that makes sense for your win rate, right? And then essentially just risk the same amount. Now this is without compound. I'm gonna show you guys here real quick. I know this is getting very long. I'll show you guys real quick the power of compound interest. We are gonna put this number at whatever, the biggest size possible. It's going to be compounding over 1,000 trades. So what does this mean? Every single time we risk, if you guys don't know how compounding, I think you should just look it up, honestly, at this point for compound interest. But every time you're not risking 1% of the original balance, you're risking 1% of the new balance. So let's say you're at 101K now for your balance after one win. You're now risking 1% of 101K instead of 100K. Let's see what happens. Bruv, see this? We make 2,230% returns. All right. That's way more than what it was before. I think that's 10 times almost more. And you're at $2 million. So you grew 100K to 2 million in a year, or over 1,000 trades, I should say, with solid average, I guess you could say, stats. And look what happens. Every time your account grows, you see these losses, they start to double and triple as well as your winners. Because it's compounding all your trades. See all this compounding? It's compounding, it's compounding, compounding. Now, as your account keeps growing, your risk and profit keeps on fortunately increasing. So look at what happens. At this point, once you get to close to 1,000 trades, you went from risking $1,000 per trade to 27K a trade. That's a huge risk change. So essentially, you could think in the beginning of the year, you were, $1,000 per trade, whatever, pretty solid, I guess. And then you start risking 10K a trade. You have 10K days, you have 20K days, you have 30K days, 40K days. This is why consistency in trading is so important. It's not always about your stats. Okay. You guys can see this, right? And what do you think happens a year after this? It grows even bigger. Now, guys, imagine this. I know you guys can't relate. I'm gonna end this video real soon, but I know you guys can't relate to this. Let's say you start with 10K. Okay, I think that's pretty solid. With compound right here, you grow 10K to 233K in a year, doing the same thing. And look at this, you're risking 1%, which means you need 100 losses to lose your account. Okay, so very rare. Let's say let's say you double this. Look at what happens exponentially. You now make 10 mil, I think that's 10 million in a year from a 10K. If you're risking 2% now, because every time your account grows, you're risking 2%, double the exponent, right? So, and that's just real quick to help you guys understand how the nature of this game is, how you grow your accounts. Hope you guys did enjoy this section, and I'll see you guys in the next one. Peace.